Hello, everyone, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 18 of 2026, and what we were describing over the past few weeks as an evolving disruption has now clearly transitioned into something far more structural and long-term in nature.
That's exactly right. The key shift this week is that the situation in the Strait of Hormuz is no longer being viewed as a temporary constraint or a negotiable bottleneck. It has effectively hardened into a full-scale structural blockade, and markets are now adjusting to that reality rather than anticipating a resolution.
And that change in perception has had a very direct and immediate impact on energy markets. We've seen Brent spike as high as $126 per barrel, which is the highest level since 2022, before stabilizing in the 108 to 114 range. That's a significant move, especially when you consider that oil is now up roughly 60% since late February.
What's particularly important here is not just the price level, but the underlying cause. This is no longer demand-driven volatility or short-term risk pricing. The International Energy Agency has described this as the largest supply disruption in history, with Hormuz flows now operating at roughly 4% of normal levels.
And when flows drop to that extent, it fundamentally changes the baseline assumptions for shipping, energy costs, and ultimately recycling behavior. We're not talking about a temporary dislocation anymore. This is a supply shock with no visible off-ramp.
Exactly. And with no diplomatic resolution in place, and mine clearance timelines still estimated at around 6 months, the market is now being forced to operate under the assumption that this situation persists well into the medium term.
Interestingly, though, freight markets are not reacting in the same way as oil. The Baltic Dry Index has held relatively steady around the 2,600 level after peaking earlier in the month, and key segments like Capesize and Supramax are still operating near recent highs.
Which is a critical point, because firm freight essentially maintains strong vessel earnings. And as long as earnings remain elevated, the economic incentive for owners to continue trading older vessels rather than recycling them remains firmly in place.
In fact, you could argue that the sharp increase in oil prices is actually reinforcing that decision. Higher bunker costs are raising the overall trading threshold, but they are also pushing freight rates higher, which keeps net earnings attractive enough to delay scrapping decisions.
And that brings us back to the same core constraint we've been discussing for several weeks now: supply. Despite all of the changes in macro conditions, supply into the recycling market is still not materializing.
Currencies are also beginning to reflect the uneven impact of this situation, particularly based on each country's exposure to Hormuz-linked energy flows.
Yes, the divergence is quite pronounced this week. The Indian rupee has weakened to a fresh record low around 94.7, reflecting its heavy reliance on crude and LPG imports routed through Hormuz.
Whereas Pakistan has actually seen relative currency stability, even a slight firming, which is quite notable in the current environment. Bangladesh remains broadly range-bound, and Turkey has seen a modest recovery in the lira.
But importantly, while these currency movements are significant from a macro perspective, they are not fundamentally altering the recycling equation. The overriding issue continues to be the absence of available tonnage.
If we move into the subcontinent markets, the overall ranking structure remains unchanged. Bangladesh continues to lead, Pakistan is firmly in second position and strengthening, India remains third and under pressure, and Turkey continues to operate at the bottom of the pricing hierarchy.
Starting with Bangladesh, the situation is quite clear. The country remains the strongest pricing destination in the subcontinent, with local steel plate prices holding in the $564 to $578 per ton range, and the currency remaining stable within its established band.
What's particularly notable is that the letter of credit pipeline issues that defined much of Q1 have now largely been resolved. Post-Eid central bank approvals have accelerated, and transaction processing timelines have shortened significantly.
So, from a financial and operational standpoint, Bangladesh is now fully ready to transact. Financing constraints have eased, pricing remains competitive, and the market has adapted to stricter compliance requirements, particularly in light of the sanctioned VLCC cases.
However, despite all of these positive developments, the core issue remains unchanged. There is simply no supply of vessels coming into the market.
And timing is becoming increasingly critical. With approximately 4 weeks remaining before the monsoon window begins to close, the ability to convert demand into actual beaching activity is now significantly constrained.
Moving to India, the story this week is largely driven by currency pressure. The rupee's depreciation to record lows is a direct reflection of the energy shock and India's heavy dependence on Hormuz-linked imports, with roughly 70% of crude and 90% of LPG flows exposed to that route.
What's interesting, however, is that local steel plate prices have not declined proportionally in USD terms. They have remained relatively resilient, suggesting that domestic mill economics are still holding despite the macro pressure.
This keeps India as the lowest-priced destination in the subcontinent, but not necessarily an uncompetitive one. Its structural advantages remain intact, particularly its large base of HKC-compliant yards, which continues to make it the preferred destination for regulated tonnage.
But once again, the same constraint applies. Capacity is available, compliance is strong, pricing is flexible, but vessels are simply not arriving.
Pakistan, on the other hand, is arguably in the most interesting position this week. We're seeing a combination of currency stability, strong steel pricing, and a significant reinforcement of its geographic advantage.
That geographic factor is particularly important under the current conditions. With Hormuz flows severely restricted, proximity to the Gulf has become a much more valuable attribute, and that is directly benefiting Gadani.
In addition to that, Pakistan's pricing remains firm, with steel plate levels around $674 per ton, and its HKC-compliant yard capacity is gradually expanding.
So, all three pillars, pricing, compliance, and logistics, are now aligning in Pakistan's favor. This is a relatively rare configuration and puts the market in a very strong structural position.
The only remaining question is execution. Whether this positioning can translate into actual transactions within the limited pre-monsoon window remains uncertain.
And with the current geopolitical environment showing no signs of near-term resolution, the probability of a sudden influx of tonnage remains low.
Finally, looking at Turkey, the situation remains largely unchanged. The lira has shown some signs of stabilization, but inflation remains elevated and pricing levels continue to lag significantly behind the subcontinent.
At current levels, Turkey remains structurally uncompetitive for mainstream tonnage and is effectively confined to the EU-regulated segment, where compliance considerations outweigh pricing differentials.
So stepping back and looking at the broader picture, the key takeaway this week is the transition from a temporary disruption to a sustained structural condition.
The combination of elevated oil prices, stable freight markets, and unresolved geopolitical tensions is reinforcing the incentive for owners to continue trading older vessels rather than recycling them.
Which means that the Q1 overhang we've been discussing is no longer just rolling into Q2. It is now effectively being locked into a growing backlog.
And with the monsoon window narrowing rapidly, the risk is no longer just delayed supply, but supply that gets deferred well beyond the current cycle.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
Until then, stay safe.
And see you next week.